Good evening, students. We will discuss the stock valuation today. There are many different approaches to make the valuation of stock, like the dividend discount model, the free cash flow to equity, free cash flow to farm, and also we have the relative valuation models. Here in this chapter, we will discuss the dividend discount model in detail and a few of the relative valuation approach also we will see. The key concepts are understand how stock prices depend on future dividends and the dividend growth. We will be able to compute stock prices using the dividend growth model. As I said you, this will be the main focus of this chapter. Understand the valuation comparables, that is the relative valuation. A few of the relative valuation approach we will see here, like price earning and price to enterprise value ratios. The basics of stock market also we'll see. The outline will be, first section will talk about present value of common stocks. Next section will talk about estimates of parameters in the dividend discount model, comparables or the relative valuation model. And the fourth section will talk about valuing stock using the free cash flows. Then stock market details we'll see. Let us start the chapter, the present value of common stock. Any financial security, if you want to know the present value, it is the present, if you want to make the valuation of any financial security, the basic principle is it is the present value of its future expected cash flows, isn't it? So any financial security, whether it is a stock, whether it is a bond, in the last lecture we have seen about bonds, there also we have seen the same principle. Any financial security, the valuation means the present value of expected future cash flows. So stock is no exception. The same. The present value of expected future cash flows we will see here, so that we will get the valuation of the stock. Now different approaches are there. We will particularly see the dividend discount model here. Other approaches also we will just uh, in a not in very detail, but we will see. Just give me a minute. Yeah. So in that way, if we want to see the present value of expected future cash flows, the immediate things come to our mind for a stock is dividends. Not only dividends, if you have a stock, the difference between your selling price and buying price is the capital gain. So these are the two things which you always take into account while making a valuation of stock. If it is talking about dividends, dividends never remain constant. So dividend grows. Therefore, for making the valuation of common stock, you have three different situations will arise. For dividend discount model, I'm talking about, if you are talking about dividends, then three different situations will arise. What are they? Number one, there is no growth. Absolutely, the dividend is fixed. Then it is zero growth dividend. Whatever current year dividend, that will be forever. So it is a zero growth dividend. If it is a zero growth dividend, then how we make the valuation of the particular stock. Next one is constant growth. That means what? The stock will pay dividend at a particular constant growth rate. For example, current dividend is $2 and the constant growth rate is 10%, then next year the dividend will be 2.20. Next to next year it will be 10% of 2.20. Next to next, every year the dividend will grow at a constant rate, constant growth rate. The third situation will be there will be differential growth rates, like from first few years the growth will be 30%. For example, year 1 to year 3 the growth will be 30%. Year 4 to year 7 growth will be 15%. Year 8 onwards the growth will be 5%. Then in this case you have different stages of growth. First stage is 30%, next stage is 15%, then you have a constant growth of 5%. So these are the three situations will arise when you are making dividend discount model for valuing a common stock. Now let us start one by one. Case 1, so we have three different cases. Case 1, zero growth. Case 2, constant growth. Case 3, differential growth. Let us start one by one. Zero growth. Assume that dividends will remain the same forever, no growth. That means D1, as we discussed, D1 is equal to D2 is equal to D3. If dividend is $2 current year, $2 next year, $2 next year, next to next year, and it will be forever. It is a perpetuity. You know present value of perpetuity in the time value of money. What is the present value of perpetuity? That is equal to cash flow divided by the cost of capital. Cash flow here is dividend divided by cost of capital R will be the price of the stock. It is too straightforward. So zero growth, case 1, too straightforward. Here the dividend is constant. Now remember the time value of money we have discussed, where the present value of a perpetuity, here same dividend forever, that means it is a perpetuity. So present value of a perpetuity is equal to cash flow divided by cost of capital. Here the cash flow is dividend divided by cost of capital is the R. So dividend divided by R is equal to the price of the stock. This is zero growth or case 1. Too straightforward. Let us go to the constant growth. Case 2. Assume that dividends will grow at a constant rate of G forever. That means what will be the scenario? $2 is the current dividend. Next year dividend D1 will be D01 plus G. That means $2 if growth rate is 10%, $2 multiplied by 1 plus 10%, so 2.20. Second year dividend will be 2.20 multiplied by 1 plus G. Third year will be D2 1 plus G. Like that it will continue at a constant rate. Then what happened? Again time value of money. It became a perpetuity with constant growth. You remember the formula? The formula for perpetuity with growth is equal to D1 R minus G. So if the growth rate is constant and forever, then also the formula is not complicated. D1 R minus G. For example, in our situation, what example we have taken? $2 is the dividend. $2 is the, for example, $2 is the dividend, and the growth rate is 10%, and the cost of capital, for example, 15%. The price of the stock will be is equal to, very simple, $2 is the current dividend. Okay, current dividend is equal to the current dividend, $2, constant growth rate 10%, and cost of capital is 15%. So the valuation of the stock will be is equal to the current dividend multiplied by 1 plus growth rate divided by R minus G. R is equal to 15% minus G is equal to 10% will be the 44 will be the price of the stock. Current stock price will be, the current stock price will be $44. So this is too straightforward. Current dividend and little, I will zoom the page, yeah. Current dividend is $2, constant growth rate is 10%, and the cost of capital is 15%. Therefore, the formula is too straightforward, D1 R minus Z. D1 is equal to, we have seen D0 1 plus Z. So D1 is equal to D0 1 plus Z divided by R minus Z. I hope it is clear. Now let us go to the example given in this chapter. Suppose Big D Incorporation just paid dividend of 50 cents. It is expected to increase its dividend by 2% per year. That means growth is 2%. If the market requires a return of 15% on assets of this risk level, how much should the stock be selling for? Simple. Here this is equal to, now I'm changing the price of the dividend the company paid is 50 cents, and the growth rate is here 2%. So here it is 2%, and the cost of capital is 15%. Therefore, the stock price will be 3.92. Very simple. Current dividend multiplied by 1 plus growth divided by R minus growth will be the price of the stock, 3.92. Alright, so this is the way we calculate for case 2, that is called constant growth rate. What are the two situations we have seen now? One is no growth, that is equal to perpetuity, cash flow divided by cost of capital. The second one is constant growth. Second case is constant growth. Say for example, dividend paid is 50 cents, growth rate is 2% forever, cost of capital is 15%. Therefore, D1 divided by R minus Z. D1 will be D0 1 plus Z. D0 here is 50 cents multiplied by 1 plus growth is 2%, 1 plus 0.02 whole divided by R minus Z. R is 15%, so 0.15 minus Z, that is equal to 2% minus 0.02 will be equal to 3.92. Now the case 3. Kindly, case 3 is an important one, so kindly put your concentration here and note down your questions so that we can discuss. Differential growth rate. Differential growth rate means there will be, like the question, previous question, the growth is 2%, the cost is 15%. Here it will not be like that. If there is a single growth, then it is a constant growth rate. Very simply, we can do D1 divided by R minus Z. What if there are different growth rates? So, differential growth part 1, that is, there will be only two growth rates, like assume that dividends will grow at different rates in a foreseeable future and then will grow at a constant rate thereafter. In that case, to value a differential growth rate, we need to estimate future dividends in the foreseeable future, estimate the future stock price when the stock becomes constant growth stock, then it becomes case 2. You see what happens? First of all, we will calculate the dividends for the number of years of first growth. Then when the growth will come to a normal growth forever, then it will be like case 2. We will calculate the stock price at the normal growth rate. Then we will add the present value of both to get the price. Let us see how it is. Assume that dividend will grow at a rate of G1 for n number of years, then grow at G2 thereafter. See the difference, students. In the case 2, there was growth, but there was only one growth G. But here we got two growths. Growth G1 for n number of years, maybe 3 years, 5 years, 7 years, n number of years. Then it will grow at G2 thereafter. Then what will happen? D1 is equal to D0, 1 plus Z1. D2 is equal to D1, 1 plus Z1 is equal to D0, 1 plus Z1 square. Similarly, we'll go up to Dn, where Dn minus 1, you see, whenever you D1 means D0, D2 means D1. So Dn means Dn minus 1, 1 plus Z1 is equal to D0, 1 plus Z1 to the power n. Then what happens? It is the n number of years finished. If it is 3 year, then we will go up to D3. If it is 5 year, we will go up to D5. So first growth level we have calculated at G1. First growth stage up to n number of years at G1 we calculated. Then we will go to the next growth, and that is forever. No need to go to n plus 1, n plus 2, n plus 3, no need. Only we will go for n plus 1. Why? Because this is the second stage of growth forever. Then what we will do? It will be like case 2. N plus 1 will be like case 2. So dn plus 1 is equal to dn. N plus 1 minus 1 is equal to n. So dn plus 1 is equal to dn 1 plus g2. Here the second stage growth will come, which will continue forever. That means it will grow. There are two different stages now came. One, growth up to n number of years at G1, then n plus 1 year at G2. So D0, D1, D2, like that up to Dn we will calculate. Then we will calculate the Dn plus 1. After that, so first stage we will do we will calculate the dividends up to that number of years. We will calculate the present value. Then we will go to the next dividend at the for forever at the same like D1 R minus G, like case 2. Then we will add both of them. So go to the time value of money. If there are number of years constant, you know that, then it becomes an annuity, because G1 you know how many number of years, it's not forever, therefore it becomes an annuity now. Present value of annuity is equal to the cash flow divided by R minus G, 1 minus 1 plus G to the power T divided by 1 plus R to the power T. Then you will add back 1 plus here, because that is the perpetuity. First of all, we will calculate for the present value of the dividends for the number of years it is at G1. Then we will calculate G2, and we will use the same case 2, D1 divided by R minus G. We will add both of them. For that, D1 divided by R minus G will be for perpetuity, divided by 1 plus R to make it present value. The annuity is present value already given, but the second stage is not the present value. So we have to divide by 1 plus R to the power 3. If it is 2 number of years, then it is perpetuity. If it is 5 number of years, then perpetuity. Then first 5 years you have to calculate the annuity. For the 6th year, you have to calculate the second stage through perpetuity. D6 divided by R minus G2 divided by 1 plus R to the power 5. How? We will do through the example. Then consolidating both of them, there are two parts of the formula. First one, the present value of the G1, the dividends at the G1 growth, that becomes an annuity. So present value of the annuity plus the dividend at the second growth stage at the perpetuity. Once you add back both of them, it will be the value of the stock. It looks complicated, but it is not if you are doing through the spreadsheet, that is called cash flow out. Let us do this exercise. A common stock just paid a dividend of $2. Dear students, here try to keep certain things in mind how to do this exercise in the spreadsheet, and through formula also we will do it. A common stock just paid a dividend of $2. That means D0 is $2. The dividend is expected to grow at 8% for 3 years. As I was telling you, 3 year, 5 year, 7 year, the first growth rate number of years will be given to you. First growth rate here is 8% and it will continue for 3 years. Then it will grow at 4% in perpetuity, means forever. So you got G1 8%, G2 4%. G1 is for 3 years, that becomes an annuity. G2 is 4 years, that become a perpetuity. Cost of capital is 12%. In this case, we can do this exercise through the formula method. How we do it? First, we will use the present value of the annuity. Cash flow $2, 1 plus G divided by R minus G. That is all, G will be G1. 1 minus 1 plus G1 divided by 1 plus R1 and 1 plus R to the power T. T is 3 years given in the question. First G1 will be for 3 years. Then the dividend of the third year will be 2 multiplied by 1.08 to the power 3 multiplied by 1 plus growth. Growth is G2 divided by R minus G2 whole divided by 1 plus R to the power 3. This is the way in formula we can do and get the answer like this. It will be 28.89. Alright. So this one we have done through the formula method. Now let us do the cash flow out method in the spreadsheet. How we do it? First of all, 0 year, 1 year. 0 year, the dividend is $2. 1 year, the dividend will be $2 multiplied by 1.08. Second year, $2 multiplied by 1.08 to the power 2. Third year, $2 multiplied by 1.08 to the power 3. Here the first growth finished, 8% finished. From fourth year, the growth will be 4%. So the fourth year dividend will be $2, third year dividend, $2 multiplied by 1.08 to the power 3 multiplied by 1 plus growth of the fourth year and forever, 1.04. Divided by R minus G, the case to perpetuity, R minus G. That will equal to 32.75. 2 multiplied by 1.08 to the power 3 multiplied by 1.04 whole divided by 12% minus 4% is equal to 32.75. That 32.75 is in the year 4. That must be present value must be calculated divided by 1 plus R to the power 3, 1.12 to the power 3. Then it all comes to 28.89. But this way it is looking complicated. Now let us do the same exercise through the spreadsheet. Simply what we have done here. Yeah, you see here the rates I have given, the same question, whatever information is given, we have written here. Initial growth rate is 8%. Number of years the initial growth will continue is 3 years. Second growth rate is 4% and required return is 12%. Dividend of current year will be $2. Now what will happen? Simply we are calculating the cash flow out approach. So first, second and third year the growth is equal to 8%. Alright, very clear. First 3 years I have taken. Why? Because those 3 years is having growth 8%. Thereafter growth will be 4%. Then it will become a perpetuity D1 R minus G. No need to calculate. So first 3 years growth is 8%. Then what will be the dividend of first year? Dividend of current dividend $2 multiplied by 1 plus growth is equal to 2.16. That is the dividend D1. Dividend of next year. Now we will calculate the present value of 2.16 because 2.16 after 1 year. Today, what is the value? Is equal to the present value is equal to PV. Then it is asking what is the rate. Rate is equal to cost of capital 12%, but it is fixed. So F4, because we will go down, so it will be remain fixed. Number of NPER. NPER is year number 1, comma, PMT, no payment in between. Future value. Future value is equal to minus 2.16. Bracket close. Enter. So 1.93. So once you do that, you can make like this. So it will give you the value. Stock price is 32. Okay. So 2.16, its present value will be coming 1.88. Now, same like 1.7, second year, what will be the dividend? Second year dividend is equal to first year dividend multiplied by 1 plus growth is equal to 2.33, present value is 1.76. Now, third present value is 1.76. Third year dividend, second year's dividend, 1 plus growth, the present value is 1.66. So, all the present values we calculated as 5.30. Now, what happened? Once you calculated the 5.30 first stage growth rate, you have calculated all the dividends and its present value. Added back, it came 5.30. That is the annuity part of the formula. Now the second part of the formula is D1 R minus Z, that is equal to I73, that is equal to 2.5193 multiplied by 1 plus growth 2, that is equal to I64 divided by R minus Z. R is 12% minus Z is 4%, 32.75. Now calculate the present value of that stock, 23. How we will calculate the present value of the stock? The same formula like present value, rate, period, then there is no NPER, there is no payment, so payment comma, future value is 32.75. So present value, the rate is equal to 12%. Here no need to fridge because we are not going down, comma NPER. NPER, how many years you are getting this? 3 years, comma PMT. The PMT, there is no in between payment. Future value 32.75 is the future value. Enter 23.31. Now what happened? We have calculated the present value of all three dividends at 8% rate, that became 5.30. Thereafter, the second stage growth rate is 4%. We have calculated the price at year 3 and we calculated the present value of that. Add back both of them. Add back both of them to get the price of the stock. That is equal to 28.61. Let us see the formula, what it says. 28.89. Understand now? We will stop the recording here. Just give me a minute.